Hi, folks. Welcome to the Economic Reality Channel. My name is Kurt. Today is November 12th, I believe. And thanks for stopping by. I wanted to share a couple things with you today. Yesterday, I talked about Warren Buffett, Oracle of Omaha, and how he was so heavily divested into cash and cash equivalents as it relates to the market. So I wanted to go over a couple things with the market to try and help people understand um, why the markets are sitting at all-time highs, but yet there's so much fear in the fear and greed index. So I'll start with this little chart, and I get it from CNN and Business Market Watch. You can find it in many different places, but it's called the Fear and Greed Index. And we were recently in the extreme fear category with the potential government shutdown ending and the 25 basis points rate drop by Powell and the Fed recently. We jumped up from extreme fear to fear. So this is the chart, and I wanted to show you that currently the consumer sentiment in the market is fear. Now, I ask you why, if markets are continuing to hit all-time highs, why is the sentiment situated as fear? And what would the markets look like if it was in the greed index? I mean, where would the markets be? So while we continue to hit all-time highs in markets, there's still a lot of fear out there, and I wanted to try and explain some of that. So let's take the S&P for example. So I pulled this up from MarketWatch, and it's a great article. It talks about margin debt is at a record high. Here's what that means for the stock market. So basically, what this says, margin debt reflects how much investors have borrowed from the brokers to purchase more stocks. It enables investors to leverage their gains, but at the risk of magnifying their losses. FINRA, or the S&P, this week reported that total margin debt in September rose for the fifth straight month, reaching a record $1.13 trillion. So when we look at the stock market, we look at it as an asset. Whether it's your 401k, your pension invests in certain stocks, and that's kind of the way people perceive the stock market as asset. If I or you were to go out and buy 10 shares of NVIDIA, we would convert dollars into stock share. But what's really happening is, the S&P, which consists of the nation's top 500 companies listed on the stock exchange in the U.S. So year to date, the S&P index is up 17%, but yet there's still fear in the stock market. And I wanted to show you kind of why on this chart, how it's always tied to margin debt. And this chart kind of shows us the S&P index value and the purple line is the debt associated, the margin debt associated with that S&P. So it kind of mirrors each other. So, while the S&P continues to increase in value, it's not an asset, it's actually debt. In fact, most of the S&P is leveraged with margin debt. And, so that kind of helps explain where the fear comes from, because if the S&P if the markets were to have a crash, 50% haircut, these people, these firms who are invested, will actually have to pay money on top of the loss because the asset has declined. So, I talked about Warren Buffett and how he's heavily leveraged in the cash, and, he's part of the smart money, and how the CEO of NVIDIA has sold some of his stock shares year to date, $1.1 billion. And, these are the insiders that kind of have an idea what the bubble might look like, how close we are to that stock market correction, or whatever correction might be coming. So there's this site that I pay attention to. I think it's called barchart.com. And you can put in your own criteria. So I put in trading activities. It's follow the smart money. And what it refers to as smart money is when companies, executives, board of directors, and major shareholders buy or sell company stock based on non-public company information. And I put in, for the last 60 days, the buy and sell trading that happened with transactions more than $250,000. So this isn't, small penny stock buyers. This isn't me or you going and, selling, $5,000 of our NVIDIA stock. These are the heavy investors that are either buying or selling. So over the last 60 days in this chart, I want to show you that the smart money has in fact been dumping their shares of stock, whether it's their own stock or other publicly traded stock, but these are the insiders. So it really kind of appears that the people in the know are getting out of the market at the right time. So when you look at this fear and greed index and you just kind of scratch your head, why are people fearful? Why are investors fearful about their money if the stock markets are at all-time highs? And it really kind of makes sense that, this is debt. This isn't an asset. It's like Michael Burry when he talked about the housing market back in 06 and 07, and he bet against it, and he was calling housing, everyone thought housing was an asset, and at the time he called it a debt, and he was correct. And I think we're seeing the same thing today with the markets at all-time highs. It's, often, most likely viewed by all the mainstream media and the average person as being an asset. But when you really look at all the margin debt that's tied to it, it's not an asset, it's a debt. So if this market were to ever to have a correction, which it's due for, a lot of people are going to lose fortunes, and it's going to cost them a lot of money, not just the loss, but the money that has been borrowed by the brokers to leverage all of these stocks. So something to think about as we move into day 40, whatever, of the government shutdown. I still think, banks are on, quicksand. They're still very leveraged, and depending on Fed support, Fed borrowing, and I think it's moving into the stock market, which is why I kind of highlighted how much debt is associated with the stock market, because that's basically how we're going to get out of this, is to print more money. And it looks like the Senate passed some continuing resolution bill that kicks the can down the road, like I mentioned before, buys us about 3-4 months, I think, through the end of January is what this bill is been approved for. It's got to go through the House and then signed by the president. But again, it's just getting us a little bit further down the road, through the holidays. They're walking back the $2,000 stimulus checks. It looks more like some type of tax incentive for 2025. When you file your tax return, you'll get a tax break of $2,000 instead of actual $2,000 cash, but we'll see. Either way, it's not benefiting the people for the government to stay shut down, and even if they open up for 3 or 4 months, at least some of the people can get back to work and start putting deposits back into the banking system, and maybe the system can stay on the life support for a little bit longer. But it's all tied together: the markets, the banking, government, money printing, and so we'll just continue to watch and see what happens. But that's all I wanted to share, is that when we look at the stock market, we think of it being an asset, but in fact you can actually see on paper that so much of it is leveraged with margin debt that if the market ever had some kind of pullback or correction, some type of 1929 type event, it would cripple our economy. So anyway, that's it for now. You guys take care, like, share, subscribe. I'm figuring out some new things with YouTube to expand the channel. I got to go through some two-step verification, I guess, to get the algorithm to spread the word, but I guess maybe I'll have to get my neighbor's 12-year-old over here and give me a tutorial on how to do this, YouTube stuff, because it's been interesting. So, but I'll continue at it, and y'all take care. God bless. I'll see you on the next video.